Welcome to Epic Stock Due Diligence. Please subscribe at youtube.com/EpicStockDD. Thank you.
Hey everyone, welcome back to another exciting episode of Epic Stock Due Diligence. That's youtube.com/EpicStockDD. If you haven't subscribed already, I encourage you to do so. I've got a lot of videos now, a lot more videos coming soon, and a lot of live shows as well. If you weren't able to make it to the first virtual penny stock trader convention, there's many more coming soon. But what I want to talk about within this video are people, traders that short stocks, and why traders that short stocks typically are unethical people. I'm not saying they all are, but a lot of them are. So let's start off with a very elementary explanation of what shorting a stock is. So traditional stock trading, also commonly referred to as investing, one would, let's take a fictitious example here. Ticker symbol XYZ, trading at $1 a share. We're not going to include the $7.95 commission or whatever. We're just going to talk about dollar amounts. So someone puts $100 in there at $1. So they get 100 shares. And then that stock goes up to $2 and they decide to sell. So now those 100 shares, instead of being worth $100, are worth $200. So they double their money. So if they sold, then they would profit from that. Now, shorting a stock, and let's use the same example. So someone that has $100, and there's a stock that's $1 a share, fictitious company XYZ, they invest that $100, they get 100 shares. When they're shorting shorties don't make money, and that's what they're often referred to as shorties. Traders that short stocks don't make money if the price per share rises. So in other words, the way that shorting would work, that $100 invested got 100 shares at $1. If that stock goes up to $2 and they're shorting, what that means is that they've got to cover their position. So they've got to pay back because it's gone up. It's gone up. So now the stock's at $2 and they're ready to get out of it, because with shorting, the potential for loss is infinite. I mean, it can continue to go up. Heck, it could be the next penny stock turned into Google that goes above $1,000 a share. And that person, that trader that's shorting the stock, is obligated to pay back. So in other words, if their exit point is $2 a share, that would mean that those 100 shares that they paid $100 for, they would then have to pay $200 because the price per share doubled, and they're ready to get out of that short position. So hey, lost $100 here. Here's there was my $100 investment at $1, but then it doubled, and since they were shorting, now they're out $200 out of their pocket to cover that short position. So traders that are shorting stocks, whether it's a penny stock or whatever, they want the price per share of that security to go down, because when it goes down, naturally, when and if they decide to exit, if it's below their entry price and they're shorting, then they're making money. But if it goes up, as my example just illustrated, they're losing money if they exit. And it could go, and keep in mind, it could go up and then it could correct and go back down. So just because hypothetically it went to $2, maybe then it dips down below $1 to 80 cents or something. You never know. Stocks go up and down most of the time. So why are shorters typically unethical traders? Well, there's a lot of people, and even if you're mildly familiar with how the stock market works, maybe you've been in a few penny stock forums, maybe you've seen the varying types of emotion that are present. When a stock price is going up, there's typically the people that are referred to as the bashers. And those people are trying to say everything negative that they can to try to get whatever company to go down, because they're shorting that stock. It's going up. They don't want it to go up. They're going to lose money if they exit when it's going up. So they want it to go down. And that's where the unethical practices often come into play, because, and this is a fictitious example, of course, but just to illustrate. So for example, a company releases a letter of intent, LOI. And they, when they put this out, one of the lawyers involved was, after several traders did their due diligence, they discovered that the lawyer was deceased and had been for a while. So that particular press release was quickly pulled, and then traders put that occurrence into the spotlight. This particular stock was doing well, but when that was put into the spotlight, it was touted all over the forums and everywhere, so those shorters could drive, at least temporarily drive that price per share down with fear. They're saying, oh, did you see that bogus press release that hit the newsreels? That lawyer's dead, and here's a link. And it was all verifiable information. Whereas in reality, what may have happened is that company made a mistake, and they posted a press release, and they pulled it realizing they had made a mistake, not necessarily pulling it because of what other people discovered. So in that case, the shorter painted the picture that the company was unethical and that they were the saint because they were discovering this and saving people. And as a result of that, that stock price temporarily fluttered because people were afraid. They didn't want to buy into a company that was posting what was perceived as fraudulent press releases. But then the fictitious company releases a press release saying, we acknowledge that mistake, and this is why the press release blah 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 was pulled. So then you see the price go back up because the company acknowledged that there was an error, but those shorters, those unethical shorters in the interim, they will often, and this is a wild example of the types of techniques they can use to encourage people to exit their positions, in turn driving the price per share of the stock down so that they are in better financial shape. So that's just one of many examples. The other thing that you'll see are, and typically, and this is a good way to visualize it, as I mentioned earlier, go into a forum, find a stock that's on fire, search by volume active on otcmarkets.com or whatever site you're comfortable with. Check out my other video, how to screen for penny stocks, and just search for volume actives during that day. Go to forums online associated with that ticker symbol for a stock that has a lot of volume and is appreciating in price per share. The price per share is going up, and I can almost guarantee you that within that forum you will be introduced to some of the most magnificent fiction writers in the world, because they're doing their best to craft these stories with seemingly verifiable links to accurate information to try to at least temporarily suppress that price per share so they can get out for a profit before the price per share goes up again, because people then realize that the story crafted by the short sellers was fake, and then the company news was real. So it's and this is a higher level video than a lot of the videos on Epic Stock Due Diligence, I know, and I know I've kind of been around the board within this video, because it's especially if you're new to stocks, and I hope a lot of you are, because that's why I'm here. I'm here to entertain. Obviously, nothing I say within this video or any of my videos should be considered a recommendation to buy or sell a security. I publish all of this content for entertainment purposes only. But it's just really fascinating to look at these different types of techniques that people use. And I mean, I can go on, and I will elaborate a little bit more in this video. And this is just something to chew on. And I'm not pointing fingers at any particular individuals or anything like that. But do a Google search and research a lot of these individuals that claim to provide penny stock trading classes, and they, pay for this, pay for that. Research a lot of that and really think about what's possibly going on behind the scenes, because ultimately a lot of these unethical short sellers have just a tribe of people following them, because they perceive them as being the penny stock god. I mean, they're like, whatever that penny stock person says, because they've got this, that, and that they must know what they're doing because they're making all this money. And in reality, what a lot of those people are doing is that they have these classes. Yeah, they've got a lot of people following them, but the educational process is actually encouraging their students to buy whatever. And what's interesting about this is that these stocks that they're touting, oh, this is going to the moon, blah, 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 and here's how you can do it. I mean, here's why you know it's good, because you learned this in my class. Check out these indicators. And in reality, what's often happening is that the person behind these training classes or whatever, they were often front-loaded. So, they may have picked a random 000 whatever price per share stock that still had decent share structure, nothing too negative associated with it, and they front-loaded. So, they put in whatever amount of money. They got millions of shares for next to nothing. And then they bring in this tribe of people, their students, and their students they're all over this stock because they know it's going to do well. And sure enough, that stock it does really well. And it's a situation where not just for the shorter, from a short trader's perspective, they would also they would be invested in both sides of it. So when the stock went up, they were front loaded with potentially millions of shares. The stock went up, they cashed out. So they're making money. They made money when it ran up. And then they implement whatever type of fiction writing they want to put into play to encourage the stock price to go down. Before it goes down, they're shorting the stock. So then when it goes down, they're making money. So a trader that short sells stock, to conclude this video, the best way to visualize it is that they're often in direct control of the pump, or indirect control of the pump. Like I said, they're front loaded going in, so they make money when it goes up, they get out. And then they short the stock before it starts to tank, and they're making money when it's going down. So whether the stock's going up or down, they're making money because of a stock that's manipulated. So think about this, and think about it when you hear of training classes and people that short stocks. Think about this and really question, what are they up to? Because I will tell you, Wall Street is not, it's not a friendly place. I mean, there's good people out there, and I know a lot of good people, but there's a lot of unethical people. So I hope this video is of value. Share it with others. Be sure to check out my book if you want to. It's entitled The Penny Stock Perfectionist. It's available in the Apple iTunes store. You can find the link on the main page at youtube.com/EpicStockDD. Got my picture up there in front of the bull on Broadway, and it says buy my book. So if you want to check it out, you can. It's only a few bucks. If you don't want to, like I said, no pressure. I'm not here to sell stuff. I'm here to entertain. And hope y'all found this video to be entertaining, and y'all have a good day.